In 2020, 4 messages. First, we do not expect recovery next year. Maybe in some countries we may have recession if we have negative shocks. Second, we do not expect surge in the inflation rate, whether we are in US or in Europe. Third, to avoid any risk on economic activity, monetary policies will remain very accommodative with very low interest rates. And fourth, political risk are the main risk for next year. We will have the presidential election in the US with very heterogeneous point of view, whether you look at Donald Trump or at Elizabeth Warren. There are risks in China with slower growth and Hong Kong. And in Europe, we have a new commission and Christine Lagarde at the head of the ECB, and they will have to keep Europe in flows in discussion between US and China.
For 2020, we believe that continued monetary accommodation will prevent yields to go materially higher. US yield will stay under 2%, and in Europe, we forecast for stable yield going forward. So in this context, we like carry assets, including credit, high yield in Europe, where default rates might stay low, and emerging markets because of the external debt will stay relatively stable, in our opinion. In equities, bear in mind that the slowdown will impact earnings. Valuations are a bit elevated, so that markets may not accommodate downside surprises on equities. So we look for some consolidation there. However, we think that the value theme has run its course, and come back to growth is an idea to position portfolio for next year.
The challenge for 2020 is that we are in a non-cooperative world looking for a new equilibrium. That's a real challenge on the economic side, on political side.
Disruption in the market might provide the opportunity to build carry trades that we like in credit and high yield, for instance.